So we do have a pullback after a pretty stunning July that was broadly positive for most asset classes against the backdrop of data that seemed to confirm all of these interest rates that have gone up did not materially break things. Things might be cooling down, but we're certainly not falling off of a cliff. But yesterday, as I mentioned, we did get that senior loan officer survey, which is a survey of loan officers at the major banks that's just simply ask, what are credit conditions right now? How willing are you to make loans? And credit conditions are pretty tight. In fact, when they're at these levels, they tend to coincide with recessions in the United States. Could this time be different? Let's bring in Iman Brivanlou, who's managing director in high-income equities at TCW Group, which manages over $200 billion in assets. Iman, thank you so much for being with us. You know, when I talk about the senior loan officer survey, this is not some, far-flung sentiment indicator. This is essentially the grease of the wheels of the economy. And if you have these people pulling back, how can you not get a recession? How are you thinking about that?
Yeah, well, Amber, thank you very much for having me on your program. I agree that this survey that you're mentioning is a cause for concern. As you know, C&I loans provide companies with funding for various near-term purposes, such as working capital or to finance CapEx. And as you mentioned, we view it as a key lubricant for a well-functioning economy. So, to the extent that there is a tightening here, we think that's going to certainly act as a headwind. I would say that more broadly speaking, this is essentially a reflection of what we saw earlier, with the issues that were unearthed with the regional bank failures in the U.S. Those issues haven't gone away. They're still with us. And, I think they're causing banks to focus more on shoring up their own balance sheets. And it's going to result in tighter lending standards going forward. So something to watch for sure.
So is something to watch or something to position for? How are you positioned on the back of the multi-month highs that we are sitting on for both the S&P and the NASDAQ?
We're at an interesting time point. For the most part, earnings so far have generally surprised to the upside, a few exceptions, notwithstanding. Management commentary has tended to be stronger. Outlooks have been better than expected. All of this has fueled, a rally that has broadened. You add to that generally strong macroeconomic data, dropping inflation, a data-dependent Fed that seems to be on pause. And it seems like the soft landing or no landing scenario has really gained a lot of credibility over the last month. But we would urge caution. We think it's a little too early to call a victory here. We would remind your viewers that there tend to be inherent variability in lags with regard to the impact of monetary tightening. We probably haven't felt the full consequence of the rapid rate hikes earlier this year. The inverted yield curve, we think, is another signal that bears watching. Typically, that harbingers a recession, but the first thing that occurs is the removal of the inversion. So the uninversion begins to occur, and that's where we are now. And then I would add that, even though earnings have been strong, as I just got done telling you, is better than feared good enough for a 19 times or 20 times forward multiple on the S&P. And we think not. So we would continue to urge caution, and we would actually pay very careful attention to the type of stocks that one would add to the portfolio at this juncture.
Well, and then when you're screening for that, you obviously are looking for income in equities right now. You want to make sure that it's sustainable and that you're not falling into these yield traps. What's screening out to you as attractive opportunities?
So, you put your finger on it. We're looking for companies that have demonstrated pricing power, companies that could withstand the recession. So typically those would be companies that have inelastic demand characteristics and valuation support. In our universe, the valuation support primarily comes in the form of sustainable, well-supported dividends. So if a company is yielding, 4%, 4.5%, 5%, and we have high confidence, because of the visibility of the cash flows, because of the sustainability of the model, because of the experienced management team and mature business, then to us, that's an attractive company at this juncture, going into what we still think is going to be a recession here.
What's an example of that?
We like towers. American Tower is a great name. It's one of our largest holdings. There is a long-term secular growth story with regards to demand for towers, and we think that roughly 4% or 3.5% dividend yield is very well supported with potential for growth.
I know I ask you this all the time, but I'm going to ask again. The trade-off, of course, is just sitting in a risk-free bond that yields more.
Yeah, and that value proposition certainly is compelling. If you can park your cash in a 5%, call it 6-month or 1-year Treasury yield, why would you bother with stocks? And our answer is that we don't know that we're going to go into a recession. As you can see, the rally's broadened. I just told you that I think the tail risks are less likely now. Something like an AMT would give you some measure of upside capture. So you will get the 3.5% dividend yield, but at the same time, you'd participate in case it is off to the races and in case it is a no landing scenario. So we think it's a better value proposition at this juncture.
All right.